Thank you, Mary, and good morning to the participants and good morning to our speakers for today. This is a great day, and I'm glad that you managed to find time to join so that we can learn a bit on this current phenomenon called the ESG, that is the environmental, social, and governance factors, and how they relate to the insurance industry in a way that is sustainable. So mine is to welcome you and, of course, to lead you in an opening prayer. And then I will invite Madam Director, our Director, Alice Njoroge, who will give her remarks, and then we'll invite the speakers. So I'd like us to give God some honor and just bow as we pray. Thank you, Heavenly Father, for this day. Thank you for enabling us to see it. Thank you for your provisions, and thank you for our health and our intellect. We pray that as we go through the webinar today, you will give us the ability to comprehend, to understand, and to put to practice what we shall learn today. Enable us that we may come out of here better off than when we joined, because we pray in Jesus' name. Amen. Now I'd like to welcome Director, Madam Alice. Please take over. Thank you.
Thank you, George, and thank you everyone who has logged in. Give me a minute, I try and turn on my camera, and Gideon is assisting me do that. I don't know. He has put so many firewalls such that we are not able to penetrate Gideon. And in the event that I'm not able to do that, please delegates around me to speak off the camera. Gideon, are we there now?
Yes, we can hear you.
Okay, I know you can hear me, but my camera still cannot go on. I don't know what you've done. Oh, okay. I'll speak off the camera, though that's not really nice to welcome people that cannot see you. Gideon, are you there? Are you able to do it?
Not on my end.
Okay, all right. So good morning and Happy New Year to all the insurance professionals. This morning as IIK, we are delighted to host you. We are delighted to welcome you to this ECG program. I know ECG is what is in everybody's mouth, and we as your professionals, as your institute, we found it fit to try and get you the experts to try and dissect what is ECG, what is its relevance to our industry, how do we apply it, and we therefore wish to welcome each one of you. I know you are eager to learn. We know you are ready to adapt and to be able to apply ECG into our daily lives as insurance professionals. And therefore, I just wish to extend my heartfelt to welcome all of you on board so that we can run together, so that we can be able to move together as an industry, and we can be able to adapt with the world changes and what is happening in the world, so that we are not left behind in the market. And as the council, we could not be able to get any better experts to be able to dissect the program with us than the speakers that we have today. And therefore, members of the profession, I would want to to invite you to help me welcome our speakers for today, starting with Edna Kimejo. Edna is an assurance manager at the Deloitte & Touche, and she's the manager in charge of sustainability for the last 7 years. Angela holds an MSc in sustainability business from the University of Leeds, and therefore delegates help me welcome Edna, who will be part of the panelists that we have today. We also have Francis Gare, our very own, who is in charge of climate change and ECG in Gemini Insurance Company. He will be able to give us the reality on the ground as insurers. Where does ECG fit in? How do we help how do we adopt it into our daily lives, into the businesses that we are underwriting. And members, we cannot have a better person to dissect the topic for us than Francis Gary, and we tap from his experience. We also have Iara, who is the African Implementation Officer of Principles for Sustainable Insurance. She has over 10 years of working experience in the industry and holds a master's of degree in civil engineering. That's interesting for us because we know insurance has some civil engineering with it in Algeria, but however, she's a chartered insurer. And members, please help me welcome our speakers for the day. And without much ado, I will welcome the moderator who is moderating this session for us so that she can kick in and let us know how they have organized themselves on how they carry the program. So because we are not physical, we cannot be able to welcome you with a clap. I'll do it with a snapchat and say, welcome to our speakers. And I hand over to the moderator to take over from there. Thank you.
Thank you, Director.
Mary?
Thank you, Director. And without wasting any time, I'd like to welcome Mr. Francis Ngare, who's a climate change and ESG and sustainability expert from Gemini Insurance, to take us through the ESG definition, foundation, and importance to business. Welcome, Francis.
Mike. Okay. Hello, everyone. Is everyone able to hear me?
Yes, we can hear you, Francis.
Okay, thanks a lot for this opportunity. I think what I'll do is to share my slides regarding what we are doing and where we have. And in particular, I should be able to share with you on 3 topics. What is ESG, the ESG foundation, and ESG importance to business, because the other speakers again will come and build onto that. So without wasting so much of time, one, I would wish to kind of let you know that Gemini Insurance is a member or a signatory of a Nairobi Declaration for Sustainable Insurance, effective last year. And there's so much that have been done, which at some point you'll be able to hear the experience that we have from our own GM. So let's go straight to the question of what is ESG? And what I would wish to let you know that ESG is an acronym for environmental, social, and governance. And these are 3 broad areas for consideration on any company's performance presently, basically on risk exposure along the financial factors in the economic decision making. So many companies or other investors are looking for in analyzing a company based on its sustainability. And when we talk about sustainability, it's about the issues to do with the environment, how the company is interacting or dealing with the issues of the environment, how it's dealing with the issues of the social issues, and also the governance that it has within its management. The next slide will deal with the issues of the overview. As I mentioned, ESG is an acronym for environmental, social, and governance. And as I mentioned, again, these are 3 areas that are considered in terms of how the company is performing. For example, if I may use example because I like using the example, it is about when it comes to environment, how are you dealing with issues to do with adaptations of climate change? How are you dealing with the issues of ensuring those projects that are dealing with the climate change, say, for example, the hydro dams? How are you dealing or doing how is it impacting on the issues to do with the social? Are you ensuring those companies that are having issues with the workers? Or are you dealing with the companies that are dealing with the issues that have to do with the human rights in a way that you are ensuring what is not ethically right? So that's how I would put it in a way that you are able to kind of understand it in a simple language. The next slide is
Francis,
what is the basic definition? Yes.
Allow me to interrupt kindly. Put the slides on a presentation mode so that we can be able to view better.
Oh, okay. Okay, that's it. It can be seen now, yeah?
No, it's still not on presentation. Oh, yes, that's better now.
That's better now, yeah? Okay, so I was on the definition of ESG. ESG in real definition refers to a set of measures that can be used by stakeholders, particularly the investors, to judge how companies are impacting on the world, not just making profit. In the past, investors who could look at a company so that they buy shares or maybe to interact with or to deal with that company, they used to look at, oh, how is the financial performance? How is it performing in the Nairobi Stock Exchange or any other stock exchange? But nowadays, there is a new dimension. Beyond the profit and the financial performance, how are you impacting on the world? And impacting on the world means how are you dealing the community around where you operate? How are you dealing the issues that I mentioned about the climate change and about the issue of the, including your governance? So in other words, that's the definition of the simple definition of ESG. When you talk about ESG, as I mentioned, there are 3 pillars. These 3 pillars, E, S, and G, means environment, social, and governance. On environment, it refers to impacts on things like energy use, water use, greenhouse gas emission, and other pollutants, waste management, biodiversity maintenance. These are standards that are most measurable when it comes to issues to do with ESG, because at the end of the day, you've heard what I've said, that these are things that are supposed to be measured. When it comes to ESG, E factor is the most easily measured and most well developed in the world because of the concerns that have been raised across the globe. The other pillar is about the social impact, which refers things like human rights, gender equality, labor rights, and working conditions of the employees, their health, their safety. And of course, it includes the issues of the relationship within the employees in a company, and also how you deal with the community that surround you in the areas of operation. If you take, for example, a company that is dealing with agriculture production, if I can use, say, for example, a company like Del Monte or Kakuzi, or maybe James Finley, it's about how it sits well and how the community around where they are operating, they perceive it. If, say, for example, without mentioning any company, you are producing certain agriculture produce, but when it comes to the community, there are cases of that where you are kind of maiming or killing some members of young men because maybe they have picked one fruit. What does that tell? What does it tell about your social interaction with that community? It means, whereas they are in poverty, you are making profit. You are not. They are not able to see the spillover of the financial performance. So as an example, that company should be able to deal with those issues around that company in a way that maybe they provide water, maybe they provide certain health clinics, etc., etc. When it comes to the G, which now deals with the governance, about the issues of the company itself, the transparency, and how it holds its issues. These are about the shareholders' rights, the board of directors, the diversity, the oversight. Both, say, for example, when it comes to the issue of, there's also the issue of compliance, all those things, including the compensation and the fair compensation of the employees. Those are the issues that are looked at when it comes to the pillar of governance. Now, at this point, maybe you are wondering, these are things that maybe you have been doing all along, but it may be a bit different. You know, there is what we call corporate social responsibility, and now there's ESG. Corporate social responsibility. Maybe you are doing dams as a company, you have been helping certain communities, you have been going visiting the vulnerable ones, children's home, etc. You've been planting trees. And the CSR, those are just committed. In and what we usually call you have volunteered. Okay, you have volunteered to do that. So that's different from ESG, because ESG is mandatory. Okay, so if, say, for example, I talk about things to do with the two, these frameworks are kind of driven by a external institution. That's the difference between the CSR and the ESG. ESG is externally regulated. CSR is more qualitative and subjective reporting. So you report not obligated. And it has to have metrics. It has to be it's mandatory. Again, when it comes to CSR, it's hugely a marketing tool. Where it in your report, so that in a marketing way you are seeing that you are doing good for the community. In a way that you are seeing that. Can you hear me now? Can you hear me? Can you hear me?
Yes, we can hear you. We can hear you, but your connection is intermittent.
Oh, my connection is intermittent. Then it's sorted. So it's done now. Alice?
Can you hear me? No, we can't hear you, Francis.
What about now?
Yeah, that's better.
Can you hear me?
Yes, we can hear you.
Okay,
yes,
okay.
Please.
So I was about a comparison of CSR and ESG, and what I said is that CSR is a bit different from ESG. One is that CSR is something that you do as a company out of what you want to do, and it's a marketing tool. And again, it's driven by internal frameworks. So largely it's internal, it's an internal thing. But one thing that the other thing that comes out is that CSR started a long time ago. ESG started some year back in 1970. I remember well, it's 1971 because we see the journey. So, but one thing is that ESG is decision making. So, unlike CSR, which is internal, ESG is something that shows it's a framework how you are being judged by the outside world. CSR is inside out. ESG is outside in, how you are seen. Okay, so that's how it is. ESG is different from CSR. Now, there's something that I would wish also us to understand. ESG and sustainability are closely related. Okay, so at some point, you'll hear company reporting on sustainability, others will be reporting on ESG, but they are closely related. One, sustainability drives its meaning from the E. It builds from the pillars of ESG, the 3 pillars that we have mentioned, and it has a meaning on meeting the needs of the present without compromising the ability of future generations to meet their own needs. In other words, sustainability means that as you meet your own needs, like say, for example, today, the profit, building a good house or driving a vehicle or whatever that you are doing, Do not do it in a way that it will compromise the future generation. When they will come, they will find that your actions kind of compromise their way of meeting their own needs. In other words, it's about doing what you are doing presently while you are mindful about the future generation. If you are building or you have an industry that is emitting greenhouse gases, that will cause a global warming, that will have an impact in the future because there will be extreme weather events which will affect those generations that will come, and those effects will not be reversible in their time when you are gone. So that's how it is. Let's look at these pillars of ESG. Again, I wish to kind of show that these pillars, if you start with the environment, those are the factors that are looked at: climate change adaptation, biodiversity conservation. We also have energy use. We also have environmental compliance. There's also the greenhouse gas emission, pollution, resource depletion, waste management, and water use. Are you able to hear me, everyone?
Yes, we can hear you. We can hear.
Okay, then we can proceed. So that's the pillar on environment. So you've been able, sorry, somebody who told me that somebody has said that you are unable to hear me, and I had to clarify. So the other pillar is about the social pillar, okay? The social pillars look at those issues. These are issues to do with the child labor, diversity, equity, and inclusion. When you talk about diversity, equity, and inclusion, it's about how, maybe, for example, in your company, you have included maybe the minority, maybe the gender issues, and also the diversity in terms of those who have certain capabilities, and also how fair are you distributing their pay, such that in a working environment, there are no segment of the employees who feel that, well, my compensation does not correspond with my effort and the kind of work that I've been doing. The other bit is about the employees' relations, health and safety, human rights, local community impacts. Again, you remember what I mentioned. As you exist, wherever you are doing your work as a company, be aware of what impact you are driving or what the community around you see you. This is what is called the social license to operate. How they view you. You may be making a lot of money and you are proud, but gauge yourself what the community think about what you are making the money. Okay, you don't want where you have maybe a situation and you find the community is not responding even to your issues, and you wonder, what have I done to the community? Because you have never fully understood how the community perceive you, because you are not making impacts on them. So the other bits are issues to do with the privacy, security, and also education and training of the employees. Let them have the unions, and also whistleblowing and reporting. You should be able to have a mechanism in which they can be able to kind of air certain things that are not happening right in the company, and they feel ownership. The last one is about governance, and those are the issues that are usually looked at. I mentioned about them, both diversity and structure. Majorly, and it has been seen, any organization whose board compositions constitute 50% and above of women performs better. Any organizations whose board of directors is led by a woman performs better and has certain resilience. That's something that has been seen globally, and research has shown that. Then there's the other bit of the executive compensation, how they are compensated in terms of their salary. The other aspect is about bribery and corruption, political lobbying. We are all in this insurance industry. Of course, we are looking for business, those tenders. When you go for these tenders, in practice, at times we like lobbying a certain high figure politician so that he comes in and support and support you in the bids. When it comes to ESG, when you are implementing ESG, those are issues that can come under scrutiny because that's unfair competition, because you are driving undue advantages. I'm just saying so because that's how it is. Then, of course, there's the risk management, the procurement practices. And when it comes to procurement practices, about doing something which is called sustainable procurement. So ESG pillars are just as they are read, like you are seeing on the screen. There are 3 pillars. Those are the metrics that are usually involved in terms of measurements when you come to reporting, and that's what the external investors or stakeholders would wish to see how you are doing. So, but again, at the end of the day, these are not just things that you say, okay, I'm impacting on the community. It has to be quantifiable. It has to have data behind it, reliable, and it has to go all the way to the details. How many people are accessing the water for that project that you did in the community? When it comes to the employees, how diverse are they? There has to be a certain reporting now that it shows the disabilities, the disabled are composed of up to this percentage, and they are holding these roles, that kind of thing. It has to be executability and available in such that if you say so, somebody can be able to come and see, yes, what you said is right. But at the end of the day, when you are developing your strategy, it is not the same for the other company. It depends on your individual company and the sector in which you are operating. Like for insurance company, the way we develop our ESG strategy is different from financial institutions like the banks. And again, we are companies. Geminia will do it differently from the other companies, that the 42 other companies that exist, because they have their own way, their culture, and their own way of the target market. Okay, so that's very important. Now, ESG has a history. Where did this ESG start from? Because majority of you may be wondering, this is the time we are hearing about it. Where did it start? Okay, let's see the history and where it started. Number one, it was started in 1962 to 1967 on the United Nations resolution. I think a majority of you, not majority, a few of you may have heard before South Africa was given its independence. There's what was called United Nations Resolution 1761. This dealt with the issues of apartheid in South Africa, where it was resolved that all the companies and countries, or rather the countries, should boycott and kind of avoid South Africa because of the apartheid rule. That's when the ESG started taking shape. So this was an military measure aimed at pressurizing South African government to dismantle the systems of apartheid, and no United Nations members were requested to isolate South Africa economically, including halting military and economic and cultural exchange. And this was very important because in 1990s, South Africa was able to get its independence. The other aspect, the other history, came in 1977 from what is called Reverend Rayon Salvana, who set a certain 6 criteria for which companies were to operate in South Africa. You remember, you can see United Nations came directing the countries. Then Reverend Rayon Salvana's principles came to direct companies had to behave in that country. So pressure was piling on. And again, this was about the treatment of workers. Some workers could not eat with the whites. They could not board on the same bus, etc. Those issues. That's how ESG was building that here. Then came 1999. We had the Dow Jones Sustainability Index, which created a certain set of the way companies should be seen globally and be rated. And this is a fruited adjusted market capitalization weighted indices that measure the performance of companies selected on the basis of environment, social, and governance and economic criteria. Remember those criteria that I mentioned? Now they were kind of they started being effected in 1999 through this Dow Jones Sustainability Index. Okay. Then we have the year 2005. This and the ESG was gathering steam. For the first time, the term ESG was mentioned. Yeah, it's now got into the books in what was called the UN Global Compact. in a study, if I remember, it was a study which was referred to Who Care Wins. Okay, so this brought the principle. It's not a matter of you making profit so much huge amount of money. It's about also dealing the issues of environment and social. Then it means you could win. It's not winning because you have made so much profit or you are doing well financially. It's about those impacts that you had on environmental, social, and how your company was composed. And that's how it came into being. And this was under Kofi Annan leadership in the UN that, again, a certain group of investors were called in so that they could develop certain principles which came to be referred to as Principles of Responsible Investment, PRI. Then come 2007, this is where now again, as ESG was gaining momentum, climate change issues were coming in. European Investment Bank issued the first world green bond. This was about driving awareness about issues to do with climate change, and they raised so much amount of money, which was allocated to leading to projects that are contributing to climate actions in renewable energy. Say, for example, the wind power and also energy efficient sectors that were now veering off from the fossil fuel, or rather the petrol, etc. Come 2015, and the message was home. This is when the United Nations Sustainable Development Goals were published, and it got support from so many countries. Merely, Paris agreements about nations, it does not give obligations to companies to do that, but companies have come to kind of embrace ESG, and that's how it came into being. So now, when you talk about sustainable development goals, you remember how we link sustainability to ESG? Okay, so the sustainable development goals have to tackle those 3 pillars, and there are 7 of them. Then it depends on where you are operating, whether you are in health, whether you are dealing with climate change, etc., etc. And this is a framework for international cooperation aimed at in promoting sustainable development, and it's a framework that has a time span between 2015 and 2030 with certain metric. Majorly, it aims at reducing greenhouse emission below pre-industrial levels up to 1.5, up to 2 degrees Celsius, and make an effort to reach to 1.5. So the Sustainable Development Goals are 17, and they have 169 targets. So let's go to the importance of ESG, because you've had the whole story of what is ESG, how it has come, what are the metrics, but you may be wondering, the whole of this story, where does it lead us in terms of insurance? Okay, and do we require it? Or even if you are not insured, whichever business you are operating, even if you are own personal business, how much does it matter? Number one, it has been shown that 88% of institutional investors subject ESG to the same scrutiny as operational and financial consideration. Okay, so if your company is listed in Nairobi Stock Exchange, or you are looking towards investors coming in to inject money to your company, remember nowadays it's no longer about how your books looks good. It's also about your ESG issues. Okay, they don't want to come and inject their money where you are violating human rights, where you don't want to also do not care about the environment, etc. Okay, that's an important figure. That's according to the what we call the Edmund trust barometer. They will trust you. They will trust your figures based on that. Okay. Then 64% of the investors would invest based on their belief and values. Again, you can see their belief. Figures are good, but they believe that what you are saying regarding the environment, regarding the social fair, leading the community, and also your board governance, they have to believe. There has to be that believability regarding the values that you hold here. Then 60%, again, based on that study of 2021, is that those investors, or rather the investors choose to pay, or rather the employees choose to work in an organization that is dealing with the issues of environmental, social, and governance. That's sustainability. Okay, you know where these figures are coming from? Of course, the largest workforce currently is Millennium and Millennium majorly. They are very conscious about sustainability. When they are working in your company, we used to see the issues of sustainability, okay? Unlike the old generation. So the 60% reflects the fact that that is the generation that is currently working in the majority of the company, okay? Now, the same generation, which is 58%, say they buy or advocate for brands based on their belief and values. Okay, so they are willing to sacrifice something if at all there is an element of sustainability. Okay, these are figures. Again, now let's come now to the generation. I think there's a crash of the generation. Those generations that are willing to invest, because the millennial generation are currently the one that is now investing what has been left by their parents. 2/3 of them are very much concerned about the environment and social issues like carbon emission and income inequality. So that young man and that young girl you find working there and he belongs to the millennial, those are the issues that he holds dear beyond the paper that you give him. Okay, now this is where you have a problem again. The generation that is getting out of workforce, 58 years and above, they are called the baby boomers. These ones, they are not concerned about the issues of sustainability. They are somewhat, or they are not interested, and yeah. So what does that tell us here about the importance of ESG into business? The workers, the investors are so much concerned, so your company depends on investors and the stakeholders, and your workers are among the group that are so much concerned about the issues of ESG. So ESG is something that you need to consider in your business. It's now something that is almost mandatory. Besides, regulations are coming pretty fast. Now, 74% of countries have certain mandates that require you to report on ESG or sustainability issues. And if you look at our country, already the banks have a guidance effective from 2021 to be reporting on issues to do with climate-related risks. I don't know how far we are when it comes to the insurance sector, but I know certain regulations are on the way. So it is very important to kind of value the importance of ESG. So those numbers represent something that is affecting your business or interest. So you may not avoid it to have ESG and sustainability issues or factors in your company and to have a framework that's dealing with that. But that's a graph which is very interesting. Maybe you can take, you can have a look at it. You can see Millennial and Generation Z, how they are performing in terms of how they view the ESG importance to business. Okay, you can see the baby boomers. Baby boomers are those that belongs to those that age that is, remember the 1970s when they were the issue of family planning and sustainability were not on board, and it was I think that's when the birth rate across the globe went up. So that generation kind of, you can see they represent only 20%, so much low, and they are not concerned. So that graph says a lot in terms of those people you are interacting with as an insurer, as an investor. Okay. So there are certain advantages that are associated with having ESG in your company. Number one, it will give you innovation and a competitive edge. When you are working with that segment of the population that Generation Z, and they feel that you are taking care of ESG and sustainability issues, they will bring innovations because they are more likely to kind of feel they are comfortable working there. Number two, when you have ESG, as you found, investors are looking at these issues of ESG when they are viewing about your company and the value it holds. So you have a competitive edge. If you are taking care of environment, social issues, and etc., and your board composition and the G issues, you have a competitive edge to be supported in any course. So that's very important. And that also includes the point number two. Point number three, the financial performance, of course, has been shown that it improves tremendously. We are very much arrived to a certain company that had issues to do with the adult children which were being sexually harassed, I think, in the Rift Valley. You know, it's a multinational company in the tea sector. Right now, because of that issue, they had to pay certain fines. And right now, I think the company has been sold because they found that they cannot deal with they cannot continue operating. Another investor who is in this country, just recently, I think last week or this last month or so, they were fined, I think, around a certain billion because of procurement issues. You see, these are related to ESG, so things are happening. If I don't know who can remember, it's one of the supermarkets. Remember, they were fined a certain amount of figure which was very high because of ESG issues. Now, regulatory compliance is another benefit. We may say that, well, I don't know, Madam Director, you'll tell us where regulations are, but I know somehow they are on the way to be a requirement for insurance company to have sustainability or ESG and sustainability reporting. It will be a requirement, just like in the bank. In fact, we are it. So when that comes, it will be one of the requirements for compliance in terms of regulations. So it's very important that you have this, and you have an important an advantage business-wise if you are able to be to be compliant with ESG at the regulatory level, and if you are not, maybe you'll be barred from transacting business. Because again, as an insurer, you don't want to be insuring what they call climate chaos. If you go and insure a certain activity that is violating the issues of or it's contributing to climate change that affects the community, again, you'll be held to account. The other advantage is that, as I mentioned, again, it's related to the issues of the kind of a segment of the population, the Generation Z, rather the Generation Z and the millennium. Because they hold so dear about sustainability, if your company has that a sustainability culture and framework and also goes at asset and they feel that you are tackling that, they are more likely to stay with you. So, and given these are current retentions will come in, okay? The other bit, which is number 6, is about customer loyalty. Customer will find that you are so much concerned about the sustainability and environmental issues. You are not the one who is dumping waste around the road. There's a way that you are treating them. There's a way that you have opened up to them. The issue of cybersecurity, the issue of safety of their data, which is related to the social issues. They will be loyal to you and they will stick with you. Okay. The other bit is about strategic planning. ESG is one of the tool for strategic planning in terms of where you want to go, where you the kind of product you want to innovate, especially in the insurance. But I know one of my colleagues in the presentation will be able to tackle this. Finally, when you do good, you win. That's the aspect of corporate citizenship. So I think I've dealt with the 3 aspects that I was supposed to cover. What is ESG, the importance of ESG, and also the history of ESG. My colleagues who are presenters, I think they will be able to build on that foundation, but at least right now, you understand what is ESG, where did it come from, and it's important to business. So back to you, is it Mary?
Thank you very much, Francis. That was a very good and very informative session. We appreciate. Thank you for taking us through the definitions, the foundations, and the importance to business of ESG. The next session, we're going to have ESG principles, risk integration, and forums in place. And after that, we'll also have another session, which we're going to be taken through the ESG products, the insurance concerns, and the principles of sustainable insurance. The last session we're going to have a session on ESG reporting standards and perspectives of ESG in various global markets. So at this particular time, I'd also just like to confirm that we will be able to share the presentations, and the questions will come at the end from around 12:10 p.m. is when we'll have a Q&A question session. So please, if you have any questions, you can also feel free to write them down at the chat box. So this time I'd like to invite Iara de Sousa, who's the Africa Implementation Officer, Principles for Sustainable Insurance, PSI. So Iara, take it away.
Thank you, Mary. Are you able to see my screen?
Yes, if you can only put it on the presentation mode, that will be perfect.
Okay. It is okay now?
Yes, it is. Thank you.
So for my presentation, I'll be trying to tackle on why the ESGs matter to the insurance industry. I will start by giving a brief description of the triple role of the insurance industry, and then moving on to why ESG matter to the insurance industry. And then I will dive into the principle for sustainable insurance and try to take you over all the work that we have been doing and the benefits of the PSI. And then we'll move to the best practice for overcoming ESG challenge within the industry and a way forward, and but finalizing with some resources that we have related to the ESG's integration within the insurance industry. So as a starting, let us dive into the triple role of the insurance industry. As my colleague Francis mentioned, the ESGs are based on impact. So now we move a bit to the insurance industry. What is the role of the insurance industry as a risk manager, as an insurer, and as an investor? So we are the risk carriers, and we have an important role when it comes to foresting sustainable economic and social development across countries. So it basically involves around the sustainable development challenges and opportunities. So as an insurance industry, we do have a role of risk management, allowing individuals and business to protect themselves against potential losses from unforeseen events by transferring risks. We as well have a role of investors. We invest premiums from various cedents, and then we dive into the financial world, fueling the economy and development with the premiums that we invest. And we as well have the role of the insurers, which is as well a role of social protections, right? We provide financial support during times of needs, and it is as well important, and it is the reason why the insurance industry has a really important role when it comes to the application implementation of the ESGs, because all the work that we do around risk management, around investments, and around social protection involves into the main role of the ESGs. So we need to understand that we understand the risk, we prevent, and we reduce the risks around the communities. It is one of the reasons why we need to better understand and manage ESG issues in order to promote resilience and sustainable societies among us. So moving into why ESGs matter to the insurance industry, let us say that insurance must consider these factors to improve their ability to anticipate, mitigate, and adapt to emerging risks. The ESG factors on risk management and management in the insurance industry. Let us start with the environmental side of it, which it is one of the most important ones, especially for the insurance industry, because we are on a business where we end up paying for claims. And as we see currently in our continent, we are being hit by several events related to climate change. And those events are having an impact in our books in terms of claims, in terms of profit, and in terms of exposure. It means that it has a direct impact in our underwriting. It means that now the way that we see and the way that we perceive the risks change, and our approach in terms of underwriting practice should change as well. We need to embed the climate change in our underwriting practice, the natural disasters, and we need to make sure that we build our portfolios now embedding the ESGs, depending on the country we are and the type of exposure that we are facing. We need to have the ability to pick the risks that we have, analyze them, and try to aggregate them according to the phenomena that they end up suffering from. It is a long-term risk planning. It means that from now on, we need to be sure that the risk profiles that we have are adjusted to the current reality. For instance, I'm from Mozambique, and in Mozambique, we are now suffering from several cyclones on a yearly basis. The portfolios that we are dealing with now are completely different. It means that we are now trying to tailor the premium rates that we have. We are trying to tailor all the risk assessment that we have for the risks involving the cyclones that we are now facing, so that we make sure that the industry remains sustainable, and that the industry can cope with all the issues that are being dealt with. So in terms of the social risks as well, the ESG matter for the insurance industry because it considers the labor practices, the workplace safety impact, has an impact on the insurance liability. It means that it becomes as well, let me say, a moral hazard because as insurance, we need as well to be sure that we are dealing with companies that are operating in the right way. We need to be sure that we are operating in the right way and following all the requirements across the industry. And then we are as well facing demographic change. Social factors like changing demographics are influencing the type of insurance products. We are now seeing a shift in terms of type of covers. We are now trying to be more innovative when it comes to extensions, when it comes to the type and the diversity of covers that we offer to our clients. And then we have as well the governance risks, where the governance practice within an insured organization can affect the overall risk profile. The same thing applies to the insurance company, where we need to make sure that all governance practices are in place and that we follow all the standards and all the requirements that are being applied for the industry. And then in terms of regulatory compliance risks, failure to adhere to ESG-related regulations and standards may lead to legal and reputational risks for both the insured and the insurer, because we are now moving to an era where the ESGs matter, and the impact that the companies makes when operating has also a say. It is no longer a matter of making profit. It's a matter of making sure that we have a positive impact where we operate. It's a matter as well of making sure that everything we do also has a positive impact to the society that it's around us. Let us dive into the ESG's integration in underwriting. As I said before, we have to customize the premiums. We need to make sure that the premiums applied are in compliance with the risks and the performance that we are now facing. We need to make sure that according to the risk that we are facing, we understand and we deal with them on a real practical and intentional way. We need to make sure that for the business remains strong and reliable. We need to create a resilience platform across everything that we do, and make sure that we as well try to embed new products. We try to learn from the lessons that we are having now with all the climate change effects that we are facing, and make sure that for 10 years from now, we remain solid as companies and as an industry. So it means that we will move to a situation where we categorize the risk that we have. We try to engage with other markets and to understand how they are dealing with the risks. It is a moment where we're no longer doing it alone. We have to do it as one. The industry needs to get together in order to face all the challenge that we are now facing. Let us move to the PSI, which are the Principles for Sustainable Insurance. So I'll give a brief overview of the Principle for Sustainable Insurance. It is basically the largest collaborative initiative between the UN and the insurance industry, working collectively to amplify sustainable insurance thinking, practice, and solutions. The PSI is a principle-based initiative. It serves as a global framework for the insurance industry to address environmental, social, and governance issues and opportunities. It aims to strengthen the triple role of the insurance industry. And the PSI has been instrumental in pushing the sustainable insurance agenda by developing foundational concepts, frameworks, and growing a strong community of practice. As we stand, we have more than 260 members. From them, we have signatory companies and support institutions spread across 59 countries. And we hope to, now that we are starting the implementation across the African continent, we hope to have more members joining us from the continent as well. So the PSI was launched in 2012 under the UN Conference on Sustainable Development. And the vision of the PSI initiative is of creating a risk-aware world where the insurance industry is trusted and plays its full role in enable health, safe, and resilient society. The purpose of the PSI initiative is to better understand, prevent, and reduce environmental, social, and governance risks, to better manage opportunities, to provide quality and reliable protections. So the principles are four. They are basically based on the core business of the industry, clients and business partners, governments, regulators, and other stakeholders and public. As I said before, everything related to sustainability involves being one, involves integration among various stakeholders. It is the reason why the principles that we have are as well distributed in the same way. So the principle number one is basically to embed in our decision maker the ESGs within the core business of the insurance industry, which is risk management, which is social protection, making sure that in everything we do, we try to embed the ESGs issues and try to address them in a correct way. The principle number 2, it's basically working together with the clients, business partners to raise awareness about the ESGs and managing risks and develop solutions. Which is basically meaning that from the moment that we join ESG movements and ESG initiatives, we become champions of it. We need to make sure that all stakeholders working around us as well embed in their business the ESGs. It is the only way that it will be an initiative that will work and it will have a bigger impact in our society. Because if we make sure that all the value chain that we have around us are also embedding their business, the ESGs, it means that the initiative grows, and it means that the industry has more impact within the society. And then the principle number 3, we will work together with governments, regulators, and the other key stakeholders to promote action across the ESG issues. Again, it is a matter of involving all relevant stakeholders. Governments and regulators are key in order to implement any kind of standard. They will be the drive for everything. They will be the one putting in place all the regularizations that we need, and they will support the industry in case of any needs. And the 4th one, it is basically the public demonstrating accountability and transparency by disclosing publicly any progress and in implementing the principles, any progress in adaptation with the ESGs. It is making sure that the company shows to the world what exactly they are doing, the impact that they are having across the society that they operate in. So in overall, the principles are all involved in the need to work together. We really need to be sure that as an industry, we operate as one. There is no longer competition. We are now bringing our hands together in order to make sure that we make a positive impact towards development. Let me touch now on the benefits of becoming a PSI signatory. So basically, it will improve the risk management. We do have guidelines and initiatives that will help you better understand and prevent risk mitigation. We will be helping the companies driving sustainable insurance practices. We have access to expertise and global insights, opportunities for leadership and network, global and multi-stakeholder amplified impact. Basically, around the PSI, we try to make sure that all members have access to all the work that is being developed. We try to organize the members in working groups so that they be able to interact, they will be able to exchange experience, and they will be able to learn, because we are on a journey of the ESGs, and we are always learning. There is something new to be acquired on a daily basis. So it is basically a platform where the company will not be working alone towards the ESGs, but as a community, we will be just moving together towards the same goal, which is the implementation of the ESGs across the insurance industry. Now, as a way of implementation, we always try to move according to the regions. And for Africa, we have what we call the Nairobi Declaration Sustainable Insurance, which is basically the regional network of the principles for sustainable insurance. We are now with more than 150 members. And the declaration was founded in 2021 by the founding signatory is ACA Lion Group, which is a Kenyan insurance company. So we have been developing a lot of work within the Nairobi Declaration. It is a commitment for the African insurance industry. It translates the African challenges. It is a network of companies that work together to try to develop the ESGs across the African continent, because we do know that we have specific needs within the continent, and we need to be realistic about it. So the Nairobi Declaration is all about it. It's about dealing with the challenges according to the African reality, trying to we are trying to bring in what is being done on a global stage, but adjust it to our reality. So I will just as well invite all the companies that are not yet members of the Nairobi Declaration to join us. It is a good opportunity. It's a good start to start embedding the ESG, start understanding and network with other companies trying to follow the same journey across. So I will now touch on the PSI work. We have been working on the ESG risk management in insurance, the Net Zero Insurance Alliance, the V20 Sustainable Insurance Facility. I will develop a bit here on the V20 because we are working with the vulnerable countries developing climate smart solutions, and it's a great opportunity for insurance companies willing to increase their portfolio of new products and climate smart products that will help them first cope with all the environmental issues that we are facing as a continent. And it's as well a great opportunity to make sure that we try to make sure that we link the insurance companies with possible donors according to the projects that the projects and products that they are trying to develop. So we are as well working on the life and health work stream, the natural ecosystems and pollution prevention. We are piloting the TCFD recommendations, the insurance SDGs, and then as well as the regional implementations and capacity building. The regional implementation is the example of the Nairobi Declaration. We as well have the Bogota Declaration. And in terms of capacity building, we have a plan for 2024 for the African continent, where we'll be delivering capacity building with the essentials about ESG across the market, and try to make sure that at least within the insurance industry, there is a clear understanding of what exactly are the ESGs, how they can start their journey in implementing the ESGs. So let us touch a bit on the best practice for overcoming ESG challenges. I will start by saying that we do have the PSIs, but the PSI doesn't have a standard reporting framework yet. We have the principles, but what it is open in terms of how you report it, as long as it covers the 4 principles that we have. So what we are trying to do is make sure that for now you start your journey in terms of the ESGs, and thereafter, with the collaboration of the members, we'll build up to a standard that will be agreed by everyone involved. So in terms of best practices for overcoming ESG challenges, leadership commitment. We need to make sure that in all levels of the company, there is an understanding and there is a willing to integrate the ESG practices. We need to make sure that at the board level, there is an agreement. The CEOs is as well into it, and the underwriters, the marketing team. So we need to create a common understanding of what exactly is being done. I know that most of the times there is a challenge, especially within the underwriters, because they feel like that integrating the ESGs will affect their portfolio of business. So we need as well to understand that yes, for starting, there will be a cleanup because you really need to make sure that you have profitable business in your account. But then there is as well the integration of new products. There is as well the adjustment of premium rates that will cope with any loss in terms of business portfolio. And then there is as well the stakeholders engagement, improve communication with stakeholders, with investors, with customers, with employees, making sure that they understand your ESG strategy, and as well that collaborating with the ESG strategy, integrating the integrated the ESGs in your risk management. As well, you will be embedded ESG's consideration into the overall risk management framework to mitigate emerging risks. Collaborations and partnerships. Again, we don't work alone. As long as you decide to integrate the ESGs, the best thing that you can do is collaborate with industry peers. Try to link up with regulators, with governments, with all the institutions working as well with towards the ESG initiatives. It is a journey that should be done in a community so that we can have better results. A way forward. First step, don't walk alone. Join the PSI or the NDSI, the Nairobi Declaration, and work with the rest of the insurance industry in your ESG journey. Start with the simple things in your offices and your homes. Conduct a baseline analysis of the current standing of your company. Set short-term targets based on the baseline metrics. And continual improvement. Make sure that you still include in everything you do all the ESG elements. In terms of the ESG risk management insurance industry, we do have two guidelines that are here. One is the managing environmental, social, and governance risks in non-life insurance business. And the other one is the ESG guide for life and health insurance industry. Both manual will show exactly how to handle the ESGs, practical ways to integrate it in your business decisions, and as well as a breakdown in terms of in class of business, how to better start the ESG journey within your company. So I've as well put here the link so that it will be easier for downloads, so that everyone can have a look at it, and it might help in terms of your starting journey within the ESG initiatives. Thank you.
Thank you very much, Iara, for that informative session. We've learned a lot, and I'm certain at the close of the session, we will have people who will ask questions and clarifications. And thank you for being kind enough sharing the links so that people can be able to know where to move from here. For those who don't have strategies on ESG and those who want to know how to start. The next presenter, we're going to have Susanna Pardesi, who's going to give us a presentation on ESG products, the various insurers' concerns, and principle of sustainable insurance. Susanna, you're most welcome.
Thank you very much, and thank you for having me. Can you see my screen?
We can see your screen. You can put it on the presentation mode. That will be great.
Oh, certainly. Right, is that better?
Perfect. Yes, that is much better.
Fantastic. Right. Thank you very much for the invitation. I'm Suzanne Pardesi. I'm head of energy at Africa Specialty Risks, who are a specialist insurance company and cover 8 lines of business and risk transfer methodologies across Africa and the Middle East. Now, the key themes of this presentation will be the importance of ESG for insurers. My sincere apologies. I think I will be crossing some of the information with some of the other presenters, but hopefully there will be bits that are different. I will go through the insurance company considerations, what we look at when we consider ESG. How we would designing the ESG strategies with the overall company goals, incorporating ESG factors. We've just had a great presentation. How would you take the principles of PSI and incorporate them within the insurance company? And then I'll cover some insurance products as well that can assist the insurance companies with the ever-evolving risk landscape as we go on. I'll just touch on this because it has been covered already in the previous presentation, but the importance for insurers, you've got, beyond the regulators, there's a concern from stakeholders such as employees, partners, and customers who express an increasing concern about ESG issues. 80% of global investors consider how a company manages ESG risks as an important factor in their decision-making process. 76% of consumers are willing to discontinue their relationships with companies that treat the environment, their employees, or the community poorly. And there's regulatory pressures, governmental pressures on insurers for ESG, the governments recognize the importance of sustainability in the insurance industry. Compliance with ESG regulations is becoming an important aspect of risk management, as mentioned in the previous presentation. There is also the transition to mandatory disclosures. Insurers are transitioning from voluntary to mandatory climate-related disclosures and facing increased legal liabilities if they don't disclose ESG information. The need of formal ESG strategy is now very important as the stakeholders are now demanding explanations. And despite these regulatory pushes, the insurers lack still the ability to measure ESG consistently within their companies. There's no consistent method of measuring greenhouse emissions, gas emissions, for instance. The insurers have several points to consider for ESG in an ever-changing risk landscape. They've got their own transition to net zero, and then they've got the climate-related risks on top of that. So their own transition are demands by the regulatory oversights and compliance considerations. The board decision-making regarding emissions reduction and the transition planning, and the disclosure requirements, ensuring a just transition. That is a lot for any insurer to try and incorporate within their company. And then they've got the climate-related risks, where climate change and transition risk typically refers to the risks associated with the adaptation and conversion to a low-carbon economy. This includes risks from changes in policy, for example, on greenhouse gas emissions and carbon taxes, which in the event of losses can increase the loss quantum significantly if carbon taxes are involved, and therefore it's the understanding of the clients and the insurers as to the coverage they're now giving the clients and what the clients actually have covered. It also includes technological innovations, for example, around carbon capture and storage. It includes consumer preferences around shared mobility or recycling instead of replacement, and not forgetting societal and workforce pressures, of course. Some sectors of the economy face really big shifts in asset values, or higher costs of doing business as they implement ESG strategies. It's very important for the insurance industry to understand what it means for their business, and rating ESG risks is absolutely essential. Rating ESG risks correctly is essential, again, due to the technological innovations. How would an insurer create an ESG strategy collectively using the PSI principles, for instance? How would you take that and incorporate that within your own insurance company? Insurers must prioritize their values and goals, ensuring consistency across all business functions. This would involve defining sustainability principles, setting matrix, and integrating ESG considerations into their underwriting as well as other operations. So, in order to create an ESG strategy, you'd first identify the risk criteria, and you would utilize a framework such as the unit principles for the PSI, as mentioned in the previous presentations, principles for sustainable insurance, to identify the ESG criteria. You customize these criteria and align them within your own specific priorities. Not everything will be applicable, but you take as much as you possibly can that's applicable and measurable. You then define data points. You establish data points that measure each risk criteria, both qualitatively and quantitatively. This baseline data should track both the positive and the negative ESG performance over time, considering considering the company's transition plans as well, which should be an overarching umbrella, and the company's strategic principles. You would then weight the criteria, and you assign weights to each risk criteria and underlying data points, along with the UN Sustainable Development Goals. This will ensure that the ESG strategy reflects the company's unique priorities. Technology and data play a vital role in assessing and managing ESG risk. Insurers would have to collaborate with partners who can provide reliable data. And I'm also aware that, Moody's and S&P have a lot of data that they provide for ESG. However, this data is not utilized across the board. There are a lot of other private companies that also now sell the ESG data to insurers, and therefore, again, there's a drop in consistency in the type of data that insurers across the board will utilize, and therefore their ESG scores will vary. So you need to collaborate with partners who can provide reliable data and a platform for building and implementing an ESG balanced scorecard. It's a scorecard that you would have to be able to legally justify and believe that what your ESG strategy is about, and is believable and is achievable. Then you'd use a balanced scorecard to measure the ESG performances across the entire portfolio. You then identify gaps and prioritize data improvement efforts. You develop a roadmap for improving data quality, coverages, addressing and identifying gaps in ESG risk assessment. And then you'd establish targets and continuously monitor results and improvements within your company's ESG and across the underwriting portfolio, and give your company an overall ESG score. Now, to assist with the ESG strategy, there are now several ESG products that are available in the market that insurers are adapting to try and fulfill their requirements for ESG. So we've got the conventional insurance products where you've got your property damage, business interruption cover, you've got your liability cover, so on and so forth. But some part of the insurance company's ESG strategy can be incorporating these additional ESG products. Parametric insurance is a type of insurance that pays out a predetermined amount upon a triggering event. It can be structured to cover specific ESG-related risks, such as natural disasters, labor disputes, regulatory fines, by tying payouts to measurable triggers. Parametric insurance provides transparency and immediate claims processing, which makes it very ideal for ESG risks. An example of parametric would be in fact, this is something that ASR provides a cover in. We covered the cyclones in Mozambique. So if the cyclones reach a certain wind speed, parametric insurance would automatically pay out to the people that actually have been affected by the cyclone without waiting for loss adjusters to go on site and without waiting for the damage to be assessed. So it's based in that instance. The trigger was the wind speed, and the payout at a certain wind speed was a fixed amount. Flood would work in the same manner if there's a certain amount of rainfall within a period of time. Parametric insurance would pay out, not wait for the damage to be assessed. This allows the people who the customers who buy their insurance not to have to wait for the businesses to start running again, or their homes to dry up, they have access to insurance payouts immediately. So that that covers many aspects of the environmental and the social aspect of ESG. ESG liability insurance provides coverage for claims arising from environmental damage, social harm, or governance failures. This type of insurance can protect companies against lawsuits, regulatory fines, reputational damage resulting from ESG-related incidences. ESG liability insurance typically covers a broad range of risks, including pollution, workplace accidents, and human rights violations. We've then got the environmental liability insurance covers, which the insurance covers costs associated with environmental cleanups, remediation, and third-party claims arising from pollution or contaminated events. Environmental liability insurance can be tailored to specific industries, such as hazardous waste management, industrial operations, or property development. An ever-increasing risk is the risk of supply chain. So supply chain insurance provides coverage for disruptions or losses resulting from events within the supply chain, including ESG events, such as natural disasters, regulatory or compliance failures. This type of insurance can protect companies against financial losses stemming from interruptions in production or distribution of goods and services caused by ESG events affecting suppliers or business partners. Other types of insurance, microinsurance, which aims to address specific needs and vulnerabilities of low-income populations by offering affordable and easy-to-understand insurance coverage tailored to their circumstances. These sort of microinsurance is often supported by government initiatives, NGOs, the non-governmental organizations, and international development agencies. The Loss and Damage Fund is another risk transfer mechanism. This was created and signed at COP27 and became more prevalent during COP28. It's a form of risk transfer mechanism where the Loss and Damage Fund could complement existing insurance mechanisms by providing financial support for the development and implementation of climate risk transfer solutions, such as parametric insurance, micro insurance, or index-based insurance. These products can, of course, help vulnerable communities, particularly in developing countries, to manage climate-related risks and recover from losses resulting from extreme weather events, natural disasters, and climate impacts. While the Loss and Damage Fund primarily operates as a mechanism for providing financial support to address the broader impacts of climate-related change, it can play a complementary role in advancing insurance-based approaches to climate risk management and resilience building, particularly in vulnerable and marginalized communities. The ESG journey is still, I believe, in very early stages, but it's evolving very, very quickly with a lot of legislation across the board internationally. And that legislation and the standardization of ESG is still not collaborative. So the insurers do face challenges, but there are also opportunities in transitioning to a low carbon economy. But we have to really understand the transition risks and the regulatory changes that we're now facing. And in that, collaboration and adaptation are key to navigating the evolving landscape. We need to collaborate on standardized practices in the insurance and regulatory requirements. I think we are definitely on our way to standardizing and establishing best practices, especially with the help of the UN and the PSI. But again, the utilization of data and consistency in collecting that data and analyzing that data is incredibly important for the insurance industry. Thank you so much for your attention.
Thank you very much, Suzanne. That was indeed very insightful. You've given us practical aspects on how we can create an ESG strategy. You've talked to us about the various products that are available. Indeed, that has been very helpful. Without taking too much time, I'd like to invite the next presenter, Ms. Edna Kimenju, who is a Sustainability and ESG Manager at Deloitte. Welcome.
Thank you so much, Mary. Hope you can hear me well and you can see my screen.
Yes, we can.
Okay, great. Good. Is it? Yeah, still morning. Good morning, and thank you guys for joining us. And thank you for the people and the amazing speakers who've spoken before me, because out of that, you've laid the context to what I get to talk about, which is the reporting standards. And one of the things we believe as Deloitte, but also as a practitioner, is reporting is an outcome of what you have done. So, and that's at times we tend to focus on the reporting component, definitely due to compliance or requirements. But when it comes to ESG, you can only report what you've been able to do. And the setting by Francis to lay the definition and that understanding for what ESG and why it's important, and the business case for that was important. The principles and the guidance given by Iara helps a lot with trying to visualize and see how you can put in place your operating principles to help you and guide you in decision making, especially when you're having conversations around strategy, but also in developing the implementation roadmap for that strategy. Also, what Susanna has put in place has helped in trying to understand what climate risks are and how they translate into the insurance industry, what type of products have come up or are in place in the industry. And just that is to give us the ability to visualize and see what is within our grasp as an industry. And we are looking forward to actually see the ESG insurance products evolve. We've seen quite a bit in the agri space, some in the renewable energy and the clean energy sector as well, and in the natural resource management space. So we are still looking forward to the evolution of the same, and the session by Susanna was very important in helping us understand how to develop some of those products. So as I mentioned, reporting is an outcome, and and how we visualize reporting is, for the first time you're doing reporting, it can be a guiding document to the gaps that are there, especially when you're looking back on what you need in strategy and in operations, but as well as in data. So for the first report, and for the people who are adopting ESG reporting for the first time, we can use it as an indication of what gaps need to be filled. So as a roadmap to go backwards. But in actual sense, or if we are looking at the right process of doing ESG, we should be looking at how we address strategy concerns and coming up with a strategy that integrate ESG and sustainability. I'll use them interchangeably, but it can't stand alone on it. It can't stand alone. It has to be embedded in your day-to-day business for it to be effective. Otherwise, we'll end up to what Francis had pointed out in the differences between CSR and ESG. So if we let it stand alone by itself without ingraining it to a day-to-day business, it becomes something that could easily be left out. So we need to be able to explore the synergies of where ESG and sustainability plays with our ability to make money, because at the end of the day, for businesses, the bottom line is quite important, and we can't disregard that fact. So on that background, I'll just take us through the sustainability reporting frameworks globally, and then just give examples of what we're seeing locally. And I'll point out some of the things you need to note from a reporting framework point of view. I have to admit that when it comes to ESG, we actually do refer it as an alphabet of soups. So we do have quite a bit of frameworks and guidance and terminologies that keep coming up every now and again. But I will, at the end of covering the reporting frameworks, I'll just take you through something that should anchor you so you don't feel as overwhelmed with anything that comes up. So from a regulatory point of view, our reporting frameworks point of view, we have seen standards and frameworks come and go, and there's been a bit of harmonization going on. But I will focus on three specific standards and mention two additional. So the first one I'll touch on is GRI, and GRI is a global reporting initiative. And it's a standard that has been there for quite a bit and has over about 20 years. And this standard has been voluntary over the years, and it's focused on various stakeholders. So with this, what I mean is it doesn't only speak to investors, it looks at other stakeholders beyond investors. And one of the critical things about GRI is when we are trying to define materiality, and materiality here we mean what's important for the business, we look at it from two lenses. So what is important for the business? So that's looking internally, but also what impact does the business have on the environment? So, and by environment, I mean the operating environment. So we look at it from an impact point and a financial, and that's something in the field we refer to as double materiality, in order to define what is important for the business. In terms of the disclosures for GRI, you could apply GRI as a standalone report. So we see some businesses do a sustainability report that is in accordance or in reference to GRI. or we find some other businesses work on something like an integrated report and then also align to the GRI framework. So in terms of where the disclosures for that sit, it could be in annual reports, but they also give freedom for having the information sit in other places. So you could have like your website or other place that you put your knowledge documents, so long as you provide something they refer to as a GRI content index that just helps map where that information is located. I will mention in the subsequent slide why GRI, especially in a Kenyan setting, is a bit more important, but I'll mention that as we go on. Then the next one we have is something we refer to as TCFD, which is the Task Force for Climate Financial Disclosures. And as it's mentioned, it focuses on climate-related information. So this goes back to what Suzanne mentioned on getting to understand what is your physical and transition risks as regards to climate change, and how does that translate into your operating business, but also translate into your maybe financial statements. You need to have an understanding of that. And to be able to apply TCFD, they do require that you report on four main pillars, and I'll mention them subsequently. So something else that is quite important is TCFD in the last couple of months actually did fold into this next standard that I'll talk about, which is the ISSB, IFRS S1 and S2. So with regards to IFRS S1 and S2, it sits under the IFRS Foundation. So for any accountants or finance professionals, you know IFRS the IFRS Foundation do help in the development, actually do the work of development for accounting standards, so IASB. So this particular one is the International Sustainability Standards Board. And it was a board that was formulated to be able to see how do they help with sustainable financial disclosures in the industry, with a focus of having it communicate to investors. And why this is important is, as Francis mentioned, is we are seeing an uptake of investors being a bit more interested of information other than the financial information. So they are now looking at quite a bit of non-financial information as they make decisions on investments and also as part of their due diligence exercises. So S1 and S2 are two standards that have now been published. S1 being the preparation and foundational standard, which is setting the scene and giving the general requirements of how entities can be able to apply sustainability or related financial disclosures. So that's like for any accountants and finance people, similar to what we have with IAS1. So that gives just the preparation and the general requirements, or stating what is needed in terms of the conceptual foundation. So the importance of connected information, the importance of materiality, and note here for S1, they state materiality with a similar definition as what we have in the accounting standards, which omission and exclusion of information will lead the use of primary financial statements to not be able to make decisions. So that's how they define materiality. So it's very investor focused, but also to add on S1 giving us the basis of preparation, they did release the first or subsequent standard, which is S2, which now touches on the climate disclosures. And as I said, because TCFD did fold into ISSB, the requirements for disclosures for S2, and actually even S1 going forward is the same core content that TCFD had. And I'll show you what the core contents are. So those are the two standards under IFRS that are published now. However, they do state that there will be subsequent standards. We're looking at, there's talk about standards on biodiversity, and given that we do have the sister to TCFD, which is now called TNFD, which is the Task Force of Nature Financial Disclosure, now looking at biodiversity related issues. There's also talk about having a standard on ethics. There's a talk about having a standard on human rights as well. So as ISSB grows, we will have subsequent standards that will guide how we do sustainability related information. The current framework for ISSB is climate first, but not climate only. That's why they started with S2 first. But in the meantime, they do give guidance that if you want to disclose on any other information beyond climate, because with climate you have to reference to S2, then you can use industry standards to be able to guide on what disclosures to put in. And the industry standards of preference that they mention is something we call SASB. And SASB is the sustainability, it's a US-based, I've forgotten the full name for it, but it's a US-based sustainability disclosure that helps with defining sustainability disclosures in US. But they are currently working on trying to globalize it so it can speak to a global market and ensure that whoever refers to it can still use the disclosures given as guidance under SASB. For the US market, and the reason we also bring in US market in the conversation when we are looking at reporting frameworks, is there could be some companies who are located maybe in the African continent, but the holding company is domiciled in the US. That means as a fact of you being a value chain to the holding company, then there are some disclosures and some reporting frameworks that you may need to also think about. And for the US, they do have one called SEC. I have to acknowledge for the US standards, they're not moving as quick as the European standards, and I'll mention the European standards, but still it's a standard, it's a framework to actually think about and have in mind if you have a holding company that is domiciled in the US. So similarly, it has investor focus when we are looking at materiality, and it has a focus on the climate component with reference to industry agnostic. So what that means is they've given guidance on the climate disclosures. For subsequent disclosures, you can refer to the industry. And the one that goes hand in hand with it is the one I mentioned on SASB. Then in the European setup, we do have one called ESRS, so which is the European Sustainability Reporting Standard. And this one has been the front runner when it comes, and Europe has been the front runner in terms of sustainability adoption, because now they've actually made it mandatory with a staggered approach. So at the moment, it's for the large companies. Company entities need to disclose on their sustainability information. And also they state that they require limited assurance. So you're not just reporting, but you need to be able to get assurance for some of the information that is put in your reports. So these are the 5 main guiding standards that you need to think about. And in subsequent slides, I'll just dive a bit more and try and give guidance on what is needed. As I mentioned, we have GRI, and GRI, how it's put in place, it has sector standards, and sector standards help or give guidance for specific sectors on the disclosures that you may need to apply as a sector. So for example, if you're in the oil and gas sector, there's the disclosures that they've seen over time. Remember, this is a standard that has been there for quite a bit and applied for over 20 years. So they've seen and are trying to make it easier for appliers and users of this framework to be able to have an easier time. So they give guidance on what disclosures can be used for a certain sector. Then the question for you when you're doing your materiality assessment is try to figure out what is important based on what has been defined for sectors. Some of the sector guides will be a glove fit, depending on your operations, but some of them may change or vary a little bit. So it's up to you as an entity to determine what is material for you. But before even the sector standards, they give the 3 universal standards. So GRI 1 is the foundational standard, which just gives guidance on how to apply the GRI standard. So in terms of the reporting boundaries, so similar to what IFRS has as S1 or what accounting standards have as ISA 1, then GRI 1 is a similar concept. Then they do have GRI 2, which is gives guidance on the disclosures about the operating organization, which is just guidance on what you need to disclose in terms of your operations or the entities and the subsidiaries that you may have. So they do give guidance on what you need to put in under GRI 2. Then GRI 3, where the bulk of the standard is, gives it in 3 different formats. So we have a whole standard series that looks at the economic information. And when we mention economic, the governance part, I know ESG, and that's why I'm using sustainability and ESG interchangeably, but sustainability tends to be the overarching umbrella, then ESG falls under it, because sustainability, we are looking at it from a economic, environment, and social point of view. Then, as the acronym for ESG says, it's the environment, social, and governance. So the governance tends to be the overarching, but also sits under the economic. So as I was mentioning, GRI 3 has a series on the economic and the disclosures that they give as guidance for economic related information. Then they also have disclosures on the environmental related disclosures. And then they have this guidance on the social disclosures. So under GRI 3, as an entity, you should be able to get all the information or all the guidance you need for any topics that are material to you. However, they still leave the provision for some sectors that are very niche. There could be some disclosures that are not covered by the 3 series that I mentioned. They still allow for you to then apply disclosures that are reasonable to be able to report on those informations. And that, or when I mentioned the disclosures about GRI 3 is what I was referring to under the topical standards, which, as I mentioned, are in the 3 different series. Why GRI is something to take note of is the Nairobi Stock Exchange for the listed companies did release a disclosure guidance manual in 2021, around November of 2021. And the standard they applied in giving this guidance was GRI. So that means by the nature of being a listed company, GRI is a standard that you need to keep note of, because this guidance document then infers GRI as the standard that you need to use when you're doing sustainability related disclosures or working on your sustainability report. As I mentioned, we do have TCFD as well. TCFD and their core contents, and please take note that I mentioned TCFD did fold into IFRS, But the reason TCFD is still important for companies and entities in Kenya is because TCFD was the backbone behind the CBK guidance that were given in Kenya. So CBK did give a climate related risk management guidance requiring that banks disclose on their climate related information. And under climate related information, we are looking at what was mentioned, what are the physical risks emanating from climate change, and also the transition risks in terms of technology change, reputation, legal changes, and such. And how do those risks impact your portfolio? So, with reference to CBK, then the guiding principles are TCFD based. And TCFD looks at it, the core content for it is in 4. So the governance, strategy, risk management, metrics, and targets. And just to simplify this, when they mentioned the governance, is that you need to show how climate-related risks have been factored in your governance process. So who is the overseen person or body that is looking at climate related information? How does the management, what's the management roles in some of those decisions? How often do you do an analysis on climate related information? So that is from a governance point of view. Then from a strategy point of view, we are looking at how does climate related information influence your short or medium and long-term goals, and has that been translated into the operations of your day-to-day, so that we can see how climate information has been embedded into your business, and also what risks and opportunities emanate from that, which transitions quite well in the risk management conversation. For the metrics and targets given as under TCFD, definitely because this is a climate-related standard, you need to be able to give your Scope 1, Scope 2, and Scope 3 emissions. You need to also show what other KPIs are you using to track the strategy that you defined as you are discussing your strategy under TCFD. So just a recap, TCFD goes hand in hand with the CBK climate-related guidance. But also to add, TCFD does go hand in hand with IFRS because, as we mentioned, TCFD did fold into the ISSB. And now when we are looking at the ISSB and specifically IFRS S2, it does touch on the climate-related information. But beyond that, the general requirements for reporting that are defined in IFRS S1 do take a similar core content structure as TCFD in terms of the governance, strategy, risk management, metrics, and targets. And what this means when you're doing all your sustainability-related or disclosures, then this is the approach you take. So for example, if you talk about people, your people and the community, for example, you need to show how do decisions on people and community, or how are they overseen at a governance point of view, if that is what is important to your business. At a strategy point, what are your targets, and how you looking at the impact of your organization, maybe people and community, but also what's the impact of people and community on your business. Then what are the risks emanating from people and community, and how does that translate into your business? And then what metrics and targets do you use do you monitor against your strategy. So this is the guiding core content for all your IFRS conversations. So it's very important to take note of that. So as I mentioned, S1 is the preparation of the general requirement standards that just puts in place what is required for sustainability related risks and opportunity disclosures that need to be put out. And then S2 looks at the climate related risks and opportunities. And then the key disclosure topics, as I mentioned, is governance, strategy, risk management, metrics, and targets. Just to reiterate, S1, some of the guiding the conceptual foundations, as I mentioned, very similar to the accounting field. So for any people in the accounting and finance field, this will be very familiar in terms of the definition of materiality, being omitting, misstating, and obscuring of information, or any information that could be omitted, misstated, obscured, and influence the decisions of users of financial statements, then is what is considered as material. Take note that the definition of materiality here and the definition of materiality in GRI are two different definitions. So if you are applying TCFD through the CBK guidance and you're applying GRI through the NSE guidance, that means your definition of materiality will take two approaches. And if you're also applying S1, because S1 gives the financial definition of materiality, and then GRI gives the impact one. So that means by virtue of applying those three standards, then you will have to adopt a double materiality definition. And I know this, I'm clarifying this because these are some of the issues that we are seeing in the industry as we have conversations on disclosures. And I thought it's important to point them out so that at least you can see how to go about it. Then beyond materiality, similar to any financial or corporate reporting, it needs to be fairly represented, meaning it needs to be complete, neutral, and accurate depiction. And one of the key things here is a balanced view. So at times we have seen sustainability reports that make entities look great because they were developed from a very PR and comms point of view, that they actually do not depict what is actually happening with the entity. So it's very important to have a balanced view, show what you've done great, what you're not doing great, but also to minimize the maybe the backlash of what you're not doing great is just stating what's your corrective mechanism that you're putting in place to mitigate the negative impact that you may have. So that's very important in terms of fair representation. Connected information means that the information in any other point that information may lie needs to be speaking the same thing, but you can also interlink. So you don't necessarily need to put everything in your, for example, if you're working on a sustainability report, you don't need to put everything in your sustainability report. In your actual sustainability report, you could refer to information that sits in your website, for example, the board charters. If you're working on an integrated report, which is now looking at the financial and non-financial information, and you don't want to have a standalone sustainability report, you can still now reference to information that is outside to your website and other places. So the point here is your information needs to be, you have the option to connect your information, and your information needs to be connected internally, but also within the report. So if you're talking about governance in maybe chapter 2 of your report, and at a different point you do mention something on governance, you need to be able to interlink those two sections so that the user of the information can be able to go back and forth quite easily. Then one of the things that is a bit important when we are looking at the reporting timing in S1 is upon adoption, note that S1 and S2 has to be adopted by a jurisdiction. So in case, for example, Kenya has yet to adopt it, but they have already given a statement of intent for early adoption. So definitely this is the best time to start trying out this standard, or seeing the small kinks that you need to iron out within the organization before it's officially adopted. Because once it's adopted, the mention is that your reporting period and your reporting period for your annual and your sustainability related information needs to be at the same time. So when your financial statements come out, your sustainability information needs to come out at the same time. They do give transition relief for the first year, where they say in the first year you're allowed to release your annual statements first, then within half, or you can half a year, you can do your non-financial and the sustainability related information, but that's just for year one. So it's definitely something to think about. So we did touch on S2, so I won't cover too much on this because we talked about it. Just a recap on when you're looking at S2, we are looking at the physical risks, transition risks, but also one of the things we always forget is the opportunities that arise from this sector. Let me point an example of opportunity, but I could even try for insurance industry, but an opportunity, for example, in the automobile space is we are seeing a lot of commitments coming out, saying that companies like Volkswagen want to be, to have cars that are not fossil fuel based by 2035 in major markets, and then by 2040 in the other jurisdiction. So this is an opportunity that is coming up resulting from climate-related matters. So this is an opportunity that then needs to be disclosed. So under S1, we are not just saying the risks only, you need to also highlight the opportunities. From an insurance point of view, that even using the same example as automobile is, what does that mean for the insurance, automobile insurance that you provide? Is it something that as an entity you've started considering? And if so, then that is an opportunity that you can now start disclosing under S2. I did mention the ESRD, and the reason I still put this in play here is, as I mentioned, similar to the US, we do have some companies that are located in Kenya, for example, but their holding companies are domiciled in the EU. So in that case, that means by the time it gets to 2028, just taking the last period for their implementation roadmap, that means you as a value chain of your holding company needs to report on your sustainability related information through the parent company, but also have limited assurance over the reported sustainability information. So in case your entity is one that has holding in the EU, you should begin to prepare, because by 2028, that's information that will need to be reported through the parent company. And as I mentioned, I know the reporting, anytime I talk about the reporting frameworks and standards, it gets quite overwhelming. So I like anchoring using this Venn diagram. Because if you look at the disclosures given by GRI, as I said, the series runs on environment, social, and economic. Or if you look at the guidance given by ISSB, which has S1 as the preparation standard, S2 looking at climate, but other subsequent standards will come up. And we're actually told in the meantime, we can apply SASB to disclose other sustainability related information. All these standards have synergy points. And all you need to remember is the disclosures are anchored on these 3 pillars. So any new standard that comes up, you just need to know where in this pillar are they asking for disclosures. So is it the economic point? Is it the environmental point? Is it the social? And by the social, we are looking at it from a people and community. So internal, your people who help you derive your bottom line. But from a community point of view, is the community that gives you the license to operate. The environment, we are looking at it also on a two front, which is the impact your business has on the environment, but also the impact the environment can have on your business. And then economic, we are definitely looking at your ability to continue with your going concern, your ability to still generate top line and bottom line, but also the governance structures that help you run your vehicle. So anytime there's a standards and a reshuffle of a standard, let this be your anchor point so you don't get overwhelmed. All the disclosures just tend to always touch on these three points. And with that, I think in the interest of time, I'll just run through what we give as guidance to companies who are thinking about just integrating ESG. One of the things you need to consider is you need to understand where you are as an organization. So what's your maturity? Is it something that you're currently doing, or is it in small snippets? Because that's the thing. Anytime we have an interaction with an entity, you realize you're doing some things. It's just that you're not calling them sustainability yet. For example, you do have a HR function, so that means there's some things that are looked at from a people perspective. You do continue doing your business, so the economic in terms of top line and bottom lines are met to some extent. So we need to understand where you are in a sustainability journey in order to see how do we embed ESG to what is important to you so that it doesn't fall off, and so that you can be able to generate the business case or the maximum value from integrating sustainability. Then determine what is important to your business. It looks different for many entities. Some entities may have points of synergies where you find 5 of their topics are similar, but you could still find 1 or 2 are different based on their value systems and how they run the organization. Then we come to the design stage where you develop your strategy, you implement your targets, your implementation roadmap, and then get to assess what capabilities do you need in terms of resources, so people, finance, planning, to be able to implement the strategy you've come up with. Then now we come to the last outcome, which I was saying, reporting is an outcome, or then you get to develop your sustainability or ESG report to communicate all the things you have been able to do as part of the design phase. So with that, I think I'll stop there so we can take any questions that may be there. And Mary, over to you.
Thank you, Edna. That indeed was a very insightful session, very technical as well when it came to the reporting standards. It's a good lesson. We have various to choose from, and I'm sure that we are all looking now inwardly and seeing where exactly are we as organizations and what do we need to move to the next level. We're giving an opportunity for people to type in the chat box, to type in their questions, and our presenters will be able to address them shortly. So before we do that, we'd like to invite Geminia Insurance. They have been the sponsors for this particular event, and we really wish to appreciate that. And as one of the local partners and stakeholders in the insurance industry, we wanted them to tell us how their ESG journey has been, what steps they've taken, and what they are currently doing. And for this, I'd wish to invite Mr. Jonathan Muketha, who's the General Manager for Geminia, to just talk to us for just 5 minutes before we go into the question and answer session. So Mr. Jonathan, welcome.
Hello? You can hear me?
Yes, we can hear you.
Thank you very much for the opportunity. My name is Jonathan Muketha. And I wish firstly to take this opportunity to thank the leadership of Insurance Institute of Kenya for according us this chance to give a brief of where Njamina is in terms of ESG and sustainability. I also wish to thank the presenters. They have made a very elaborate and insightful presentation that you will carry home with. So I wish to briefly share with the participants and other presenters where Njamina is in this journey. It is indeed a long journey like the presenters have stated, but that notwithstanding, I would want to say that Njamina already has ESG and sustainability framework in place. And we are also members of Nairobi Declaration for Sustainable Insurance, which our MD has also made a commitment statement to its implementation. And we have also undertaken capacity building initiatives within the industry, particularly with the major players, the insurance brokers, on the relevant products And indeed, we have found that the product development in line with the principles of sustainability insurance is very demanding in terms of finances, the technical capacity, and of course, time. And we request through the leadership of the Institute to find a way on how Njamina could be enabled and the industry at large as a champion of this, how we can collaborate to be supported to take a leading role in the product development that will enable us and be compliant to the climate change requirements. So that is our appeal. And our MD and the board are very passionate to take this leadership role if we can be facilitated by the various stakeholders, the Africa Risk Capacity, the United Nations, and of course, our institute, the Insurance Institute. Thank you very much.
Thank you, Jonathan, for that presentation and for putting across your request. On behalf of the Institute, I know the director is on call, and I know we can confidently say that as the insurance industry, we are really geared to making sure that all our members and other stakeholders learn about ESGs so that we can be able to not only act for today, but as we've learned through this call that we need to act for today as we think about tomorrow. And as we continue having this being a concern to everyone, to every other stakeholders, from the employees to the people who are investing, to the people, to regulators, then we need to be able to ensure that we are in line and we have done what we need to do to comply. So at this particular time, I'd like to ask anyone with a question to either type in the chat box or to raise up their hand. I know it's a lot that we've covered within the last about 2.5 hours. But we are happy to take up any questions, any comments, anything you'd like to mention about the session we've had. Please feel free to feedback, to tell us so that we can be able to improve the next sessions, and also the speakers who are still on can be able to guide us or give us more clarification. So we'll give like a minute for anyone with a question. If there's no question, then we will give the last opportunity to the people who've facilitated this to just give their parting shot. And then after that, we'll have our Deputy Director, Mr. Kagia, come in and just give the closing remarks. So if we have any questions, please feel free to type or to lift up your hand. All right, as we can see, we have a question somewhere. And as we get the name of the person who's asking the question, we have a question from Samuel Odhiambo. So I'll give you the first opportunity. You can ask your question. Please go ahead.
Thank you, Mary. Can you hear me?
Clearly, please go ahead.
Fantastic. So my name is Samuel Odhiambo from NCBA Bank Assurance. Thanks for the very insightful presentations and for putting this together. My question is around the NDSI, the Nairobi Declaration. I think there was an indication that there were only 26 members. And I wanted to find out the membership criteria. Is it insurance companies only? Or does it include brokers and bank assurance intermediaries? In which case, then, what would be the requirement for one to become a member? Thank you.
Thank you, Mr. Odhiambo, and thank you for joining. As that is going to be handled by Iara, you'll tell us about that. And as you respond to that, one more question, you can be able to. You can also tell us how can insurance companies align their activities with the Sustainable Development Goals, SDGs. Please go ahead, Iara.
Okay, thank you, Mary. So Samuel, in terms of the Nairobi Declaration, we are now 150 signatories. And it is open to all the insurance market, brokers, insurance, reinsurers, and it is a membership base. We just have to send you the form. By signing the form, you agree to embed the ESGs within your operations, and you are also agreed to work towards the Sustainable Development Goals. It's a very simple process. After signing the form, we just return the signed form, and we will start the onboarding process. It is really simple. You can leave your email here so that I can share the form with you right after the session. What was the second one? Sorry.
The second question was how can insurance companies align their activities with the Sustainable Development Goals, SDGs?
Okay, that one is really practical. We do have 17 SDGs, and one of the things, the easiest things to do is from the SDGs, try to in your strategy pick those that your companies are wishing to work towards. It can be gender equality, it can be climate change. It should be something that will be easier to embed in your strategy, and that you know that by the end of the year, you'll be able to work towards that. You don't have to work towards all the SDGs. It's just a matter of picking those, because I'm sure that within your operations, there are already a few aspects of the SDGs being implemented. So now it's just a matter of being intentional about it by disclosing that I'll be working towards the SDG 1, SDG 2. And then by the end of the year, you'll be able to disclose according to what the progress that you've made and all the actions that you have done towards achievement of the SDG.
Thank you very much, Iara. I can see several people typing on the chat box that they would like to have the NDSI form sent to them, and I know that will be done. The other question I'd like to ask is for Suzanne. How can ESG principles influence risk management strategies in the insurance sector? I'll repeat that. How can ESG principles influence risk management strategies in the insurance sector? And the second question, in your experience, what roles does innovation play in promoting sustainable insurance practice? What role does innovation play in promoting sustainable insurance practices? Welcome, Suzanne.
Thank you. Thank you for the questions. ESG influences risk management in several ways. In that, firstly, you've got the regulatory oversight of your company, and you're performing ESG within some set guidelines. And I think what I'll do is I'll incorporate the second question answer, within the first. Now, the landscape for innovative technologies is changing and evolving very, very quickly. So for the insurers really need to understand the basis of what it is they're insuring now and how it's changed from before, as well as the policies that they're giving out. And therefore, the risk managers have a significant role to play in this. The innovative technologies such as the new hydrogen technology, for instance, for power plants, isn't something that's been tried and tested. It's not known technology, so the risks associated with it would not be known to insurers as yet. And again, within insurance for the insurers, the risks are now changing from they've always been very sort of business interruption heavy, but now it's even more so, and it's very much integrated with the supply chain and the unknown element of these new technologies coming on board and how we're going to ensure them. That's when you've got to get your ratings right. You've got to make sure the pots for any transition or new technology are readily available. You've got geopolitical risk as well to take into account now. So that all needs to be considered when you're underwriting an insurance policy, and that should be considered within your risk management tools, and it would form part of your it would fit somewhere within the goals that are within the ESG that should be sustainable. I hope that in a roundabout way sort of answers the question.
Thank you, Suzanne. That does answer the question. Thank you. The next question I'd like to ask Francis Ngari of Geminia. What challenges do insurers commonly face when integrating ESG considerations into their operations? Maybe you can relate this to what Geminia has gone through as you were doing the integration.
Okay, thanks a lot, presenter. Mary. What I've realized is that when you are integrating the ESG into the operations, it's usually a journey, and in particular, what was mentioned about the materiality assessment. That's an area that requires so much time and resources, in particular when you are dealing, one, with internal stakeholders, the employees, because you have to carry them on board, and also the external stakeholders. Remember, insurance is a bit wide. It has so many external stakeholders. One, there are those who are insured based on the lines. That's a bit of a challenge and takes time. And also products that you are developing and thinking about are also varied. And most importantly, claim management has been an issue. And when it comes now to embedding the issue of the circular economy, because that's again building to sustainability, the capacity is still lacking there. That's number one. That's the other thing. The other thing across the industry using Gemini is that, insurance are private entities. That's number one. So, and when it comes to now again, the requirement and the pressure from the global expectations, global market and the world in terms of dealing with the issues of sustainability, social, and in particular the climate change, which is so much material to insurance company, support is very, very required. And when it becomes an area that resources have to be dedicated to that, of course, the thinking is that, well, these are institutions that were first of all established for the purpose of profit. That was the main first things, not profit, but driving value for the shareholders. Now, at times, you may find that it may be felt that, okay, is this our core business as much as there is the requirement? So, in general, those are the issues that are very common. And this is where, and in particular, just as it was mentioned by our GM, that across the industry, not only for Gemini, that hard holding and kickstarting this process requires some external support. If it's Deloitte, can there be a support in a way that helps, in fact, like an insurance company like Gemini to have the framework, start off, see the risk, see the opportunities, product development in the pipelines, because like now we have a number of products and we have frameworks. Some are in the market, some are yet, because of course it takes time. So those are the kind of challenges that we find. But anyway, for us, we are fortunate that the leadership have a purpose and the goal, both impact and of course the financial considerations. But if I look at across the industry, this can be a bit of a tiring issue if support does not come. You can see in the banking sector, if I bring in my colleague from Deloitte, then they are being supported so much for greening the financial system. That's very good. It's going on very well. But insurance appears a forgotten area. Apart from NDSI, really in terms of having the product, the green product, sustainability product, support is lacking, which is where now it needs to come in pretty fast. Because when the regulations comes in and capacity is not there, then of course it means challenges for the industry. That's how I would package it. I don't know whether I've answered your question, Mary.
Yes, you have conclusively. Thank you very much. Next, I'd like to ask Edna, in terms of regulatory frameworks, what developments are shaping the ESG landscape for insurance companies? And finally, how can insurers leverage ESG data to enhance their risk assessment and decision-making process? If you can answer that within 2 minutes or 1 minute, we'll appreciate. Thank you.
Thank you so much, Mary. So let me start with the second one about the data component, because I know that's the one we are having a challenge with, especially from our continent point of view. Some of the data sets that are needed for scenario analysis are a bit globalized and they need to be localized to a local context. But the region and the space is growing, and some of these concerns are being addressed by players. But that's the challenge now to the insurance industry, especially given that they do interact with this data quite a bit. We need to be able to see how do we create areas of synergies and data sharing components that allow us to just show what's within the region and what we can utilize, so that from a data, because from the nature of our business, we do collect a lot of data. But from a data set point of view, one of the reference point for the climate risk assessments tends to be the NGFS. So that's a place for people who are doing climate risk assessments to just get the data sets or to just start off the journey. Then in terms of regulations, yes, as Francis mentioned, the regulations really skewed on the banking sector with the CBK guidance, but for listed, definitely NSE is there. And with any company that has a holding in Europe, there's the ESRS to consider. But the minute we have early adoption for IFRS in Kenya, that's also something. And for example, some of the insurance companies do have presence in the East African region. So something to note is Tanzania did adopt S1 and S2. I know they are still to work on the implementation roadmap. So that's something to think about because TZ has adopted it. So that's something that's going to affect our reporting from a group point of view. So I'd say that to begin with. So I'd urge people to start thinking about their disclosures a bit earlier before the regulator comes in with the regulation, which I know is something that's been worked on.
Thank you very much, Edna. That is much appreciated. At this particular time, I'd like to invite our Deputy Director, Mr. Peter Kagia, to come in and close up for us. Thank you. Right. We just wish to appreciate all our speakers for taking their time, preparing the slides and imparting a lot of knowledge to the participants for today's webinar. Thank you, Edna. Thank you, Suzanne. Iara, we really appreciate, and Mr. Francis Ngari, we are really appreciating. Thank you again for sharing the various links that you have shared through the notes, and Iara for sharing the forms. We are happy that from this initiative, we're going to have very many people sign up for the Nairobi Declaration and be part of that community. Because we know once we come together, we can be able to do great things. I also hope from this session that we will have opportunity to just introspect and check what we have within our organizations and also check where we can go from there. We have been given the steps and we can reach out with questions after this. All the speakers have given us their contacts, and if you need a specific contact, feel free again to reach out to the Institute, and we'd be happy to share with you the contacts. As well, we'd like to appreciate our Executive Council members who are on call. Thank you, Director, Mr. George Ogutu as well, Angela Kamau, Michael Mondi, and Mr. Peter Kagia. Thank you for joining the call. And thank you for the usual support. We also wish to just appreciate the various CEOs and MDs who've been able to join us. Thank you, Mr. Jonathan Mukeda. We appreciate you coming to join these. And also Mr. Samuel Odhiambo of NCBA Bank Assurance. Thank you very much. We also want to appreciate Mr. Julius Kiveka of Liaison. Thank you very much for joining the call and always supporting the Institute. And any other CEO or MD who might be on the call and have not appreciated them. And of course, everyone who's taken their time to come and join. We appreciate all of you. At this point, we'd like to finish up with a word of prayer. And I'd like to call my colleague, Elizabeth, to just come in and finish with a word of prayer. Thank you very much.